Hello everyone, this is Al Lupiani with the first edition of the Loop Scoop, which is a weekly financial diary or journal sharing my thoughts about what's happening in the present day economy, finance, the markets. And today we heard from Chairman Powell. Generally speaking, he said things are on course for the economy. There's Chairman Powell right there. And using conservative tone, obviously we don't know what lies ahead 2 and 3 years in advance. But he said that the banks are strong, that policy has been stable and consistent, and there's no plans for any big adjustments to interest rates or finagling with the current state of affairs as they are right now. 2 weeks ago, some of his statements were construed as being negative and pulled the markets down. Today he was much more, I felt, curated when answering questions, and he didn't go down paths where he felt he could be easily misunderstood. Some of the key issues for me related to his talk, which he really did avoid somewhat, had to do with bond yield rates, which we find now, you see here, to be 1.659, which is pretty high considering where they've been in the past year, which were down towards zero. So larger companies, financial institutions, the government find these yields more attractive, safe havens for millions, billions of dollars in relationship to what's the dividend yields are in the stock market right now. So these cause anticipated inflation fears because it's money going into safer havens, and that's typically a signal that there could be turbulent times ahead. But I just want to show you a couple of things here related to inflation. One of the big differences in Chairman Powell really made a point of saying this is that this is not the way things are today is not where we found ourselves in the past. So considering the last recession in 2008, 2009, where inflation rates were starting to skyrocket closer to 6%, followed by a period of deflation, negative inflation rates, we find that through the 2010, 11, 12, all the way up to 2020, that inflation stayed pretty much in the neighborhood of 2%. And today he made the point that that's where they're anchoring inflation, that their guidance for this economy is going to be at 2% inflation. They want to get up to 2% inflation, and then they want to stay there for the foreseeable future, which will be a sign of stability for the overall recovery of the economy. And as we can see here at the end of 2020, we started to tick up a bit from 1 to 1.3, 1.4 to presently 1.7%. So we're on our way to 2. He said that there will probably be a spike over 2 because of various factors in the economy, namely the labor force, employment. Perhaps there's going to be some issues with supply and demand and with retailers, businesses starting up again, but that's to be expected. So generally the vibe was positive overall for Chair Powell, and of course we don't know with 100% certainty what lies ahead, and this movement into the bond market, these yields typically are a natural recovery aspect of what we're dealing with right now, and we might even see these bond yield rates going up to 2% or 2.5, along with a parallel rise with the inflation. All is to be expected, nothing to be panicked about, and at the same time investors are being somewhat cautious moving forward, as there is still a lot of uncertainty, as we saw today with after his announcements of a generally positive review. The Dow Jones is up 174, the S&P is up almost 6 points, and the NASDAQ is up 25 points. So all are in the green here, which is very good, and we just will proceed here with a just amount of caution, and at the same time with positivity about the recovery after the pandemic. This is Al Lupiani with the Loop Scoop, first edition. Thank you for listening and watching, and I look forward to having more for you in the near future. Take care.